Hi, this is Jadu here, and today I want to talk about investing in property using a self-managed super fund. Now, did you know that investing in both residential and commercial property through a super fund increased by 20% between 2016 and 2021? So clearly, more and more people are finding this attractive and using this avenue to invest in property. So in today's video, I want to break down what an SMSF is, how you can set it up, the compliance and some of the regulations that you need to follow, and finally the real benefits that you can get from investing through an SMSF. So stick to the end because there's a lot I'm covering in this video. Okay, so point number one, what is an SMSF? When you look at your retail super funds, you have your Australian super, for example. Your employer will pay 11.5% of your salary into a retail fund like Australian super, and they manage that fund on your behalf. When you set up a self-managed super fund, you're managing that fund by yourself. You actually get a bank account to yourself. So this is being rolled over from the super, and you get a bank account that you have to manage yourself. So any investments, whether it's going to be in shares or in property, all of them would have been managed by yourself. Now, an SMSF can have up to 6 members. So this means that you and your spouse, for example, can combine your super and form one SMSF. A family together can form this SMSF. So what I'm finding is that a lot of people are now being capped out of their personal borrowing capacity. They can't buy any more properties, but they still want to look for avenues where they can continue buying more properties. And an SMSF is an excellent way to do so because the banks don't consider your personal debt. They're only considering how much rental income is coming from that property and how much you are contributing to that super. To set up a super fund, who are the people that you should talk to? There are 2 important people here. So one is the mortgage broker and the other one is the accountant. So you first go to your mortgage broker and he will let you know how much you can borrow and what are the contributions that you need to make to the SMSF to buy that property. Your accountant, on the other hand, will actually set up the SMSF, the corporate trustee, the bare trust, and the corporate trustee associated with that. Now, there is a fee involved with the setup, and that costs between $1,500 to about $4,000, depending on different accountants have different fees, and it usually takes about 4 weeks. It could be much faster than that, but on average, let's say it's about 4 weeks for a setup. So another big question that people have is that how much do I need to start investing in property? How much do I need in the SMSF? Now, what you need to take note is that there is no actual minimum balance, right? But you should have enough to cover the upfront cost associated with the property and also manage the ongoing expenses associated with the property. Now, let's say you want to buy a property for $300,000, okay? You'll need to have the deposit, which is $60,000, the stamp duty, another $10,000, and then if there's a buyer's agent, legal fees, etc., another $10,000 to $15,000. So you're looking at least $80,000 to $85,000 to buy a property of $300,000 in your super fund, right? But you also have to take note that it's always good to have a buffer on top of that, at least a 10 to 20K buffer, so that when you have unexpected expenses or something unexpected happening, that buffer will protect you. Speak in more detail to your mortgage broker, accountant about what you are more comfortable with, and they will advise you more around this. Now let's go into some of the compliance aspects when it comes to SMSFs, right? So the first one is that when you buy a property with an SMSF, you can't renovate it, you can't subdivide it, you can't, for example, put a granny flat at the back and get cash flow coming in from that, right? So if you have plans to do that kind of thing, then do not buy a property under an SMSF, because if you do that, then that's a violation and you can get fined for that. Now, the second important thing is that unlike buying under your own name, you can't pull out equity and put it into another property. So the only way to release funds would be to sell that property and then put it into other properties and then grow your fund that way. So that's an important point to take note. You also have to take note that traditionally deposits are around 20% or higher, and the interest rate on your loan would be higher than your standard when you buy under your own name. So those are some of the things that you also need to take note. There is this other thing which comes very close with the compliance around the SMSF, and that's it has to pass the sole purpose test. So that means anything that you buy under an SMSF should be available to the members upon retirement only, right? So the benefits should come only upon retirement. So you can't use it before retirement. For example, let's say a family buys a home and they rent it out most of the year, but during the holidays they go and live there. So that's a violation because the members and the trustees are getting benefit from that before the retirement phase itself. So that's a violation. Then the second one is the arm length rule. So everything must be at arm length rule. That means every transaction involving the SMSF must be at market value. So for example, if you decide to rent out the property to your friend and you can't rent it out for half the rent because you're getting half market value, right? And if you sell it to someone at a much lower price than market value, again, that's a violation. These are both examples of violations and it can't happen with a SMSF. And the whole purpose here is to make sure that the trustees actually get maximum benefit during their retirement and they're not, draining the funds through things like this. Okay, now we've covered aspects around the compliance and now I want to come to the really important part, and that is the benefits. This is the big one. So number one, any profits that's made in the SMSF is only taxed at 15%, unlike a 45% tax that could come and when you buy under your own name, depending on your income, of course, right? So any profit that you make, rental income that you make, that's a profit, it's taxed at a much lower rate. Capital gains tax under an SMSF is only 10% if you hold the property for 1 year, and if you sell the property after you retire, then there's no capital gains tax at all. So that's a massive benefit. Now let's look at how you can leverage using your SMSF and build a much bigger base. Now I want to use an example. Let's say you have 100,000 in your super, you don't contribute any more to it, right? After 15 years, that will become around 150,000. You don't do anything to it, you're not contributing as well, that becomes 150,000. Now instead, let's say you take that 100,000, you set up an SMSF and you buy a property for 300,000. And after 15 years, that property has doubled and become 600,000. Okay. Now you sell it at 600,000, right? The loan on the property at 20% is 240,000. So you have 360,000, and then on that you have a 10% capital gains tax, which is around 36,000. So overall, you make a 320,000 profit. Okay. So you have 320,000 sitting in your SMSF as compared to the 150,000 when you did not invest in property, right? So you can see you're starting to build out the wealth through that leverage factor. And if you buy more properties in your SMSF, you're starting to build out that wealth which you can use during your retirement. And that's the big key here. Okay. All right. Now I want to summarize the points that we have discussed here. So we've gone through how we can set up an SMSF. We've gone through the compliance and the regulations around the SMSFs and some of the rules that you need to follow. And the biggest takeaway here is the lower capital gains tax, right? So you can use leverage to build out your wealth. You build out that wealth base using property in your SMSF. And because you have a lower capital gains tax, you can buy a property at the beginning of a growth cycle, ride that growth cycle all the way till the end, and then sell that property because you have very low capital gains tax, right? You can sell that property, take the funds out, and then redeploy that into growing markets again. In that way, your wealth is starting to grow faster and faster, right? So take advantage of the lower capital gains tax situation in your SMSF and really build out that wealth base so that you have a significant sum of money upon retirement, right? So That's about it from me about SMSFs. I hope you found this video useful. Please do like and subscribe to the content. Please also comment as well about what you felt about the video. If you want me to make similar videos, also comment in the comment section about what content you would like, and I would be really happy to do that for you. That's all from me today, and I'll see you soon.